Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of JP Morgan, ticker symbol JPM. This continues our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average with the ultimate goal of taking that analysis and building a few great portfolios. This is the 17th video in that series. You can see a link in the description below to all the other videos. So before we jump into JP Morgan's business, I actually have a quick confession to make. I'm actually a huge JP Morgan fan. More accurately, I'm a huge Jamie Dimon fan. Ever since I read his book called The Last Man Standing, it came out right after the Great Recession, and I had only been in the industry for a few years, and I was trying to read and learn as much as I could from all of the industry's top investors. His book, or book about him, was one of the books that I read. I put a link in the description below if you're interested. Now, it actually has very little to do with investing. It was more glorified him and his journey and what he did in the Great Recession, and how he sort of catapulted JP Morgan from where they were to one of the dominant players in the industry. That being said, I actually had to go out of my way while doing the research for this video, and I had to be careful not to let my liking the company influence the research. So really, what I was trying to do is just focus on the numbers. So if at any point you catch me fanboying during this entire video, feel free to go ahead and just ignore that. And I don't want to show any favoritism or make any concessions because I already like the company and I like management. So you catch it, post in the comments below. Feel free to say something funny about my fanboy. That being said, let's jump into JP Morgan's business. So JP Morgan's business is actually broken into four main segments. The largest is consumer and community banking, which represents about 45% of revenue. And that segment is their consumer business, which targets everyday people like you and me. Think Chase Bank. They offer credit cards, home lending, they do consumer wealth management, they do personal checkings and savings, business checking and savings, car loans, things like that. Now, this is what the segment's revenue looks like going back to 2011. And as you can see, it's been a bit volatile, although it's been trending higher these past few years. Now, if we zoom in to just the past 3 years and we add net income, we can see how net income looks compared to revenue. On top of that, we could throw in net income margins, and we can see that although net income margins pulled back in this most recent year, they've been consistently in, let's say, the 20% range. Now, if we jump back to the segment's pie chart, we can see that the next largest segment is corporate and investment banks, and it's about 34% of revenue. Now, this segment can be broken into two subsegments: market and investment services, and then banking. Banking can be broken down into investment banks, lending, and then they have their treasury business in there. Now, most investment banks have a treasury business. Basically, what they do there is they go out and they bid for, they set the bidding prices for the government bonds that they try to buy each month. So this whole segment is where they help companies sell bonds, they bring companies public, they act as underwriters, they help with stock offerings, spin-offs, things like that. Here's a chart of the segment's revenue going back to 2010. And as you can see, in 2010, from 2010 to 2011, they had a big pop in revenue. That's right around the time when they bought Bear Stearns. They actually bought Washington Mutual at the same time, but Bear Stearns is the one that would apply to this segment. But with such an enormous disparity between 2010 and 2011, I'm actually going to eliminate 2010 so we can see what the more recent trend looks like. So now we can see there's a bit of volatility in the revenue, and we actually saw the same thing when we analyzed this segment over in our Goldman Sachs video. And if you remember what we said in that video, that was that this segment is highly competitive, and with that competition often comes lower margins. And when we throw in net income, we can see that net income actually has done fairly well relative to revenue. When we add the net profit margins, we can see that this division is doing better than the low 20s we saw in the retail banking segment. So how are their margins so good? And the answer to that is because they're awesome, because this is JP Morgan, because I'm just kidding, that's too far. Okay, sticking with reality for a moment. If we look at revenue, we can see that revenue actually hasn't done all that much over the past few years. And I know that Goldman is having a pretty good year because if you remember in the Goldman video, I mentioned that mergers and acquisitions are up, which in theory should help this division. So it'll be interesting to see how 2018 shakes out for JP Morgan. And with profit margins at almost 30%, this is a big driver to the company's overall profit margin. So this will be an interesting one to watch. Okay, now back to the pie chart, and we can see that the next largest segment is asset management at about 13% of revenue. Now, the asset management division is often driven by assets under management. And I bring this up because there are two primary ways to grow assets under management. One, go out and raise more money, either from existing clients or perhaps from new clients. Or two, get good returns. More returns equals more assets under management. And I bring this up, and I think this is important because here's a chart of revenue for this segment. And before we get too super excited about this revenue chart, remember that a lot of this was done during this very long bull run that the market's been on. And I went in this chart, I went all the way back to 2008, mostly because in 2008, the Great Recession happened. And I think it's important to point out that this segment's revenue was doing well quite then. Goldman Sachs and Morgan Stanley did a similar thing. But I remember that time period, and back then it was very difficult to raise assets. Most firms couldn't raise any assets, and in fact, most firms were losing assets. So back then I was reading a lot of what Jamie Dimon was putting out, and I was always impressed with how they managed a lot of what happened. Granted, they got a lot of good deals from the government, stuff like that, but that's a topic for a different video. So overall, I think it's important to remember that this revenue was driven largely by the bull run. So take that for what it's worth. Now, when we throw in net income to this segment, we can see that net income has done fairly well over the past few years. And interestingly, this segment falls in right in between the other two segments when it comes to net income margins. Okay, so now jumping over to commercial banking. Commercial banking does a lot of different things. They help companies and governments raise money. They finance real estate deals. They do some lending. They do some investment banking. They do some asset management. So they do a little bit of everything. Now, when we look at this segment's revenue, we can see that it's done fairly well. When we zoom into the past few years and we add net income, we can see that their net income margins are amongst the best of all their segments. They're also the smallest, so I'm not sure how much this is going to help things. With that being said, now let's jump over to overall revenue for JP Morgan and see how that looks. And as we can see, it's actually been somewhat flat since 2009. And this isn't far off from what we saw when we analyzed Goldman Sachs. So when we throw in net income, we can see that they've actually done fairly decent. They're the blue bars. We can see that they climbed from 2008 to 2012, then they pulled back a bit and they started moving higher again. Last year, net profit margins were about 25%, which makes sense when you think about how each segment performed overall. So the question is, what do we think JP Morgan's worth today? Now, you may remember in the Goldman Sachs video that we did, if you saw it, if not, there's a link in the description below. Well, you may remember that we looked at something called the sustainable growth rate. The sustainable growth rate takes the return on equity and multiplies it by the retention ratio. Retention ratio is how much the company keeps after paying out dividends, how much it retains. The result is what they call the sustainable growth rate, which in theory demonstrates how fast a company can grow without having to raise additional capital, assuming everything stays the same. Well, Goldman Sachs came in at about 3.43, Morgan Stanley came in at 5.81, and JP Morgan came in at about 6.56. So, in theory, what this sustainable growth rate tells us is that JP Morgan can grow faster than their peers. This tells me, at first glance, that JP Morgan should be trading at a premium to those companies. Okay, so that's good to know. Now, management has also stated that they believe that tangible book value is the best way to measure the company. And this chart here, this chart actually came from Jamie Dimon's most recent shareholder letter from the end of 2017. The green line is the stock price, and the blue bars are tangible book value. Now, one thing you might notice is that in 2017, there seemed to be a significant jump in the average stock price relative to the jump in the tangible book value. Now, if you're wondering the difference between tangible book value and book value, well, tangible book value excludes intangible assets like goodwill. And if you're wondering book value, if that's the same thing as shareholder equity, it pretty much is, yes. So if you look at the financial statements, you'll see shareholder equity, that's the same thing as book value. So for me, since this is where the company is focusing and what they believe will ultimately drive the value of the company, I think it makes sense for us to try to price the stock using tangible book value. So if the company views their goal as being one to grow tangible book value, well, we should only pay some multiple of tangible book value. That being said, this chart here is price to tangible book value per share going back to 2009. This is the multiple. Based on today's current price of about $103 per share, today's tangible book value per share is 1.88x. That means that it is It is take the tangible book value, multiply it by 1.88x, you end up with a $103 price. Now, using that 1.88x, that would fall about there on the chart. That being said, I'm not sure it makes sense to pay that much. I mean, if you compare it to the very tops of what historically has been price to tangible book value, we're almost there. I'm not sure we want to pay that much. If you look at the average of price to tangible book value, it's closer to the 1.5 mark over the past 10 years. Okay, now that's good to know, but let's see what peers are trading at. So if we look at Goldman Sachs, we can see that their current price to tangible book value is about 0.94x. Now that's interesting because that means if you were to buy a share of Goldman Sachs, you'd actually be paying less than tangible book value. That's good to know. Goldman Sachs comes in at about 1.16x, and then like I said, JP Morgan comes at 1.88x. Now I'm not that surprised that JP Morgan would come in higher than the other two companies since we saw a very similar story when it came to the sustainable growth rate. Okay, so what's JPM stock worth today? Well, it's already trading at a premium, that we can see. So it's tough to move that premium much higher relative to peers since it looks like it already has a pretty good gap. If we look at the past year, over the past 4 quarters, well, the average was about 2x. Well, if we multiply that 2x by the $182 billion of tangible book value, divide that by the number of shares outstanding, we get a fair value of about $110. When I look at analyst reports, well, they use 2.25x price to tangible book value, and that would give us a fair value of about $124 a share. Personally, I think we should be, at most, sticking with the past year's average, which would be about 2x. But on a personal level, I actually think it's better to stick closer to the 10-year average, call it 1.5x. But what do you think? Another thing worth considering is that JP Morgan's current dividend yield is a bit over 3%. So I think it's very possible that based on that, the stock could end up in the dividend portfolio. Growth, maybe. Management has stated the fact that they're trying to grow tangible book value by at least double digits per year for the next few years. So for me, maybe that makes sense from a growth perspective. From a value perspective, I have trouble seeing it. As much as I like management and I like the pedigree of JP Morgan as a business, I really think that we need to remain disciplined if we're going to buy companies for our ideal portfolios. I wouldn't want to overpay for it. If this company does grow book value by, let's say, 15% a year, and we jump in and bought it right now, well, what if the average price to tangible book value fell to the 10-year average? If we bought it right now, we would still lose money even if they grew tangible book value by 10, 15% a year. To me, that doesn't make a lot of sense. But what do you think? Do you think JP Morgan belongs in any of our portfolios today? I know that we're not going to build them until we're done with the analysis. We've only got about a dozen or so companies left. But let me know what you think in the comments below. Which portfolios, if any, would you put this in? And if you haven't done so already, hit the subscribe button. Thanks for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.